Good day. In a very short period of time of 6 weeks, I'm trying to give you as much information as you need to be able to become very adept at analyzing financial statements. This requires a lot of work on my part to make sure we have everything covered, but also from your point of view, an intense learning experience covering a lot of things. And in some cases, things are very clear, but in analysis, the outcome is essentially unknown. Okay, so as we look at these real companies, we're going to find there's different things we need to look into and understand. So we need to ask the question, what is happening? What's going on? How do we peel back this onion? And one of the areas that everybody is going to see in your company is the impact of taxes on the financial statement. There's both an income statement perspective, a cash flow statement, and a balance sheet. But if we look at it, it starts with the income statement tax expense. In the balance sheet, we have current taxes payable or receivable, and deferred taxes payable or receivable. Current are those that are currently due the government, and the remainder are deferred. That means they're going to be paid or received in subsequent periods due to timing differences, which we will talk about. The cash flow statement, we'll see it in cash flow from operations. So that's what's impacted there. So the determinant of the current period tax expense, we start with pre-tax income of a firm, and it's based on either US GAAP or IFRS, depending on where you're based. This is not taxable income. Okay, this is the accounting pre-tax income. Okay, some items are treated differently for book financial reporting purposes and tax filing purposes. These items can be classified as either permanent or temporary, and you'll also hear the word timing differences. So some items by tax law are not deductible, okay? And then we have others that there's different methodology for when the tax deduction may be taken. So if you look at that, the permanent items generally not deductible for tax purposes. Okay, so that's important to know. Then there's the temporary items. These are things that are reported in one period for accounting purposes and a different period for tax purposes. Okay, there will be tax expenses when the deduction is taken for tax purposes and then reversed when it's taken for book purposes. Okay, so you have a deduction that's not taken for book purposes, but you take a deduction for tax. This generates what we call deferred taxes, which is a balance sheet item. Easier to show you this example. In this case, pre-tax income year one, $1 million of book income, and you start with $1 million of tax. And in this case, tax depreciation in excess of book, meaning we took a special deduction that we're allowed, and that leaves us with $900,000 of taxable income. Now, since it's timing, we compute the tax provision based at $210,000 because that's the million times 21. Assume the 21% tax rate. The same thing here, 21 times 900. So what we have is for book purposes, we're going to book 210, but we only have to currently pay $189,000 to the government. Now, the entry to record it is debit tax expense for 210. That's the income statement. Credit taxes payable because we need to pay that now, 189, and then we credit deferred taxes for 21,000. Okay, so that's the first year. So now let's look at year two and beyond. Say we still have that $1 million of income, but this time we have an additional 100,000 of tax depreciation in excess of book. So we're recognizing it for tax purposes, but not for book purposes. So what we're going to have, and this year it's going to be $1 million times 21 is 210. 21% times $1,000,001 is 231. So we're still going to book the tax expense at 210, but we're going to debit deferred taxes and credit current taxes payable. So the book taxes are always computed based on the statutory rate. So when we're looking at this is the timing, okay, and that comes into the time value of money, which you are familiar with. So it gives you a current tax benefit. So this is the depreciation example. Now, next question that comes up is, why is book and tax different? The tax code is written from a policy perspective. Okay, it's intended to encourage and incent certain behaviors. So the tax policy in 2017 was to incent companies to buy new equipment, make investment in the company. Okay, for example, capital expenditures, buying more equipment. So tax code is written from that policy perspective. Second, to raise taxes. Okay, so they want to make more income. The government wants to make more money. So they're doing it to raise taxes. Okay. The third is to discourage other behaviors that may be harmful to the implementation of current policy. For example, trade related. The tariffs are a tax, and the tax is paid by the importer, who then either absorbs it and reduces their income or passes it along to you, the consumer. So when we're looking at these two things, it's either to incent behavior or discourage behavior, or to raise taxes. So that's why we have the tax code is not intended to reflect economic reality of matching income and expenses, which we do under both GAAP and IFRS. So you think about this, the tax code is there to incent, disincent, or to raise money. So that's why we have a book and tax difference. We want to reflect the true impact of taxes, not necessarily when it's going to be paid. Permanent differences come out, and we do not calculate the tax impact on these permanent differences. If we go to our steel dynamics, and I thought I'd put this in, we can see a couple things. One is in note 4, and this is all in the 10K. Okay, always go to the notes to the financial statement. It'll have this information. It'll give us everything we need to know. Okay, here's our current tax expense, deferred tax benefit, our total expense. So we know what these are. Okay, so they're telling us. Now, there's a statutory rate. That means that's the stated rate of federal taxes in this case. And as we can see, the tax rate was 35, then it dropped to 21. We'll talk about that in a moment. But then we have state income taxes. But look at, here's the impact of there's a big reduction tax impact from tax reform. Now, what is that? Is this tax cut and job creation? It changed the rate. So where the maximum rate was 35, it's now 21. So deferred taxes, which were previously calculated at 35%, are now going to be taxed at 21. So when these items reversed, that deferred tax liability out there was computed at 35, it was recomputed at 21, and that reduced the tax provision that year. So what we see from 16, 17, 18, we see 36.2, 13.8, 22.5. So understanding that this piece right here is what drove the difference as we move forward to normalize earnings, okay, we need to know what that is. And this is the biggest thing you're going to see, because ongoing it isn't 13.8. So when we're looking at the performance of the firm in 2017, we have to look at it on a constant basis to say, what did they do? When we keep going, they actually break down where the deferred tax assets and liabilities come into play, and both from the assets and from the liabilities. So these again are all timing differences, okay? But we know here's the net deferred tax liability is $435. Remember, last year they reduced it by the valuation. They increased it this year because of the expansion that they engaged in. And they do a reconciliation of the tax, unrecognized tax benefits